Okay, let's just jump right in. The world of investing, man, it can feel like total chaos, can it? You're getting hit from all sides with conflicting advice, crazy jargon, and all these so called gurus promising you'll get rich overnight. It's really tough to figure out who to trust or, where to even start. And let's be real here. A lot of what's sold to us as investing is really just gambling in a tuxedo. It's all dressed up to look super complex and sophisticated, but underneath it all, it's often just preying on our hope for a quick win. So that's what we're going to do today. We are going to cut through all that noise. We're going to build an investment ladder, ranking these strategies from the absolute worst, the ones that are just wealth traps, all the way up to the proven wealth builders. All right, let's start at the very, very bottom of that ladder with the strategies that are pretty much guaranteed to burn a hole in your pocket. These are the wealth traps. Welcome to the F tier, pure speculation. This is the world of day trading, using these complex things called CFDs, basically making short-term bets. And here's the key thing to get. You're not actually buying a piece of a company. Nope. You are just placing a high-stakes bet on which way a price will wiggle in the next few hours or even minutes. And often, you're doing it with borrowed money, which just cranks the risk up to 11. Now look at this number, 80%. Just let that sit there for a second. What on earth could that possibly represent? That's the percentage of day traders who consistently lose money. It's not a game of skill for most people, it's a statistical trap. The odds are just overwhelmingly stacked against you. The whole thing is designed to exploit that hope of a quick win. And that's exactly why it's sitting at the absolute bottom of our ladder. Okay, let's climb up one miserable rung to the D tier. This is momentum chasing. Now, it's a tiny step up from pure speculation because you might actually own something, but your reason for buying it is completely backward. You're not buying a company because of its value. You're buying it because the price is going up, and you've got a bad case of FOMO, fear of missing out. And this slide just lays it all out, doesn't it? Momentum chasing is all emotion. It's fear of being left behind and the greed for a fast buck. You're just chasing whatever's hot. Disciplined investing, though, is rational. It's about having actual goals, looking at the long term, and, doing your homework. One is a knee-jerk reaction, the other is a real strategy. Okay, we've crawled out of the money pits, now we get to the good stuff. The strategy that legendary investors, economists, and just decades of data all point to. This is the proven path for like 99% of people. Meet the B tier, passive investing. The idea here is so simple, and honestly, that's what makes it so powerful. Instead of trying to be a genius and find the one needle in the haystack, the next big stock, you just buy the whole haystack. You invest in a low-cost index fund that holds, say, the 500 biggest companies in the US. And then you just hold on and let the entire market do the heavy lifting for you. And if you're sitting there thinking, I can do better than that, or my financial advisor can beat the market, well, take a good long look at this next number, 97%. That's the percentage of professional, high-paid fund managers on Wall Street who failed to beat a simple, boring, passive index fund over 10 years. I mean, let that sink in. These are the experts with all the resources in the world. And even the tiny few who did beat the market couldn't keep it up. So the takeaway is massive. Trying to beat the market is, for almost everybody, a losing game. So why does this supposedly boring strategy work so darn well? Well, it boils down to three really simple things. First, the fees are dirt cheap because there's no expensive research team to pay for. Second, you always know exactly what you own. It's totally transparent. And third, it's super tax efficient because you're not constantly buying and selling. You just buy, hold, and let that beautiful magic of compounding do its thing. But what if you are one of those rare birds? What if you have the skill, the time, and the stomach to actually try and beat the market? Well, that brings us to the next rung on the ladder, the expert level. Up here in the A tier, we have active investing. This is where you're not just buying the whole market, you're carefully handpicking individual companies. And there are really two main schools of thought here, value and growth. Value investors are like treasure hunters, looking for solid, established companies that just seem too cheap. Growth investors, on the other hand, are looking for rockets, companies they think are about to take off, even if they look expensive right now. So which one is better? Well, it's not that simple. Check this out. A recent study found that from 2012 to 2023, it was actually growth stocks that delivered higher returns when you adjust for risk. That kind of flies in the face of the old wisdom that value always wins in the end. But, and this is a huge but, look what happened when that same study zoomed in on the crazy, volatile period between 2020 and 2022. The script completely flipped. It was the value stocks that proved to be way more resilient, offering better returns and protection when everybody else was panicking. So the real takeaway here is that even at this expert level, there's no magic bullet. The best style completely depends on the economic weather. It takes a ton of skill and probably a little bit of luck to get it right consistently, which is exactly why it's not the path for most people. All right, we've gone from the absolute basement of investing all the way up to the penthouse. So let's zoom out and put it all together. What does this investment ladder really look like? Here it is, the whole shebang. Down at the bottom, F tier, speculation. It's just gambling, the quickest way to lose your shirt. One step up in D tier, momentum chasing. You're letting hype and FOMO make your decisions for you. Not a great plan. Then you make the huge leap up to B tier with passive indexing. This is it. This is the proven low-cost road to wealth for almost all of us. And at the very top, in A tier, active investing, a really tough game reserved for the skilled, patient, and dedicated few. Which kind of leaves us with one final thought to chew on. We live in a world that is constantly screaming at us about quick riches and secret formulas. In that kind of environment, is choosing the simple, the patient, the admittedly boring path of long-term passive investing, is that actually the most radical, most disciplined choice you can make for your future?